Hello, welcome back to the continuing lecture in investment analysis. Now, so in our last session, we analyzed the marginal risk of the arbitrage portfolio and concluded basically that there is still, arbitrage opportunity. I mean, uh, two things we found out is that first, perfectly well diversified portfolios are not easy to construct. What does that mean? If it is a perfectly well diversified, right? Error residual, the residual standard deviation or standard error, there is still some standard error, right? And there is some alpha. I mean, if it is perfectly well diversified, right, then there should be zero alpha and zero residuals, right, or residual error, right? I mean, a standard deviation of residuals or standard error, right? which is the source of arbitrage, right? The riskless risk. In other words, if there were to be arbitrage opportunity, there should be some of this, and basically alpha, right? And if it is a well-diversified portfolio, then perfectly well-diversified portfolio, there won't be this, right? There won't be any of this. But and then if there is none of this, but everything falls neatly on the security market line, that's riskless, right? That's riskless arbitrage opportunity. We want the portfolio A to have alpha and, right, positive alpha and residuals. But of course, if it can be negative, then it will simply load the weight in reverse, right? So we came to from the actual regression, from marginal risk analysis, we came to conclusion that well-diversified portfolios are not easy to construct, right? They have, and arbitrage opportunities are few and far between because, and what does this mean? This means, standard error is zero, right? Or almost zero. And it's the same thing as saying, come on. That's a well-diversified portfolio. And that's the same thing as saying expected portfolio residual is zero, right? And also alpha is that's significant. It's not, meaning that the inflation, considering the inflation, average inflation, this is uh, not that you know significant, right? I mean, it says, the book says, statistically significant, but the t value was relatively in a significant area, right? Significant level. So my interpretation is that considering the average, inflation, this isn't that much, right? But on the other hand, by adding, risky benchmark portfolio, the marginal overall marginal increase in overall standard error is quite minimal, of course, compared to 20%, 20.11, 0.11 is really, really negligible. So so that's basically in summary, it's basically it goes on like this. Investors, however few, will invest in any arbitrage portfolio identifiable, and so there will be a large scale purchase of positive alpha portfolios, or large scale short sale of negative alpha portfolios until alpha disappears. When alphas of all well diversified portfolios are driven to zero, right? Until alphas of all the alpha, the first thing is the error will be zero. That's the first thing. That means that's the well diversified portfolio. And then second, second, I should write it like alpha becomes zero. Alpha goes to zero. Second thing is, because of Bayes, this it's commonly called correction. It's commonly called correction, right? Right. The second thing that should happen. Oh. And the second thing that should happen is the correction of so so well-diversified portfolios such as S&P 500, most residual risk standard deviation is close to zero, right? But still, the buying and selling pressure, there is still buying, although it is relatively well-diversified portfolio, but it's just a reiteration of what I already explained. There's, as long as there's alpha, right? Still there's, buy and sell pressure, and that drives alpha to zero. And if alphas of the portfolio with very small, negligible standard error is close to zero, if uh, in other words, if well diversified, if the portfolio of if the alpha value of a well diversified portfolio is zero, then even less diversified portfolios will still tend to have small alpha values, right? There will be a room for arbitrage. And so APT implies basically a hierarchy of certainty about alphas of portfolios based on degree of diversification. Yeah, alpha degree between degree of there's an inverse relationship between degree of diversification, and alpha. As degree of diversification goes up, alpha goes down. But if it is, a degree of diversification goes down, alpha goes up, right? And remember, I've been telling you, although we don't have time for efficient market hypothesis, but I've been mentioning this in passing on multiple occasions, right? If the market is perfectly strong form efficient, and I told you, that's by the theory, right? But in reality, I said market is somewhere between semi-strong form and weak form efficient. So in reality, since the market is not strong form efficient, that means there is still room for arbitrage. There's still room for making money, right? APT implies. So then our next question is, why do we still use capm despite so many restrictive assumptions, while only a few restrictive assumptions for APT? Because strictly, APT applies only to well-diversified portfolios. I mean, APT is a theory for portfolio, whereas capm is a theory for individual assets. Okay, so absence of riskless arbitrage alone cannot guarantee expected return to beta relationship. In other words, riskless arbitrage alone cannot guarantee that security market line. The expected return beta relationship means you can perfectly predict expected return by beta with the security market line, which means they all the expected returns fall neatly on the security market line, the regression line or the slope. In other words, what this means is, existence of alpha alone, right? Alpha alone, and with standard deviation, standard error being zero, right? Absence of but anyway, I don't want to. Okay, and that means it can be applied to individual securities, individual assets too. If So in other words, what this means is there is some, there are some in reality, as we already discussed, perfectly well diversified portfolio is only a theoretical concept. In reality, there are some standard errors, right? That means non-zero alpha cannot guarantee, to put it this way. Cannot guarantee. Right? This takes so much time. Okay. But you get the idea. Let me fast forward because it takes too much time to. Okay. If only a few securities, okay, that means, if the portfolio is not perfectly well diversified, that means a few securities violate SML. And if only a few violate SML, then effect on well-diversified portfolios will be negligible, and possibly SML relationship is violated for some securities, right? But if many securities violate this, security market line, the expected return beta relationship, the S security market line will no longer hold for well-diversified portfolios. You understand? If it's like, if you have troops, all, standing in formation neatly, 4 rows by, 5 columns by 5 rows, then that means, there are 25, soldiers, in a perfectly squared way, and you can't imagine that, right? Like on a chessboard, every chess pawn is, squarely organized, and then if a few of them is misaligned slightly, it's still, it looks, decent, but already the perfectly well diversified, portfolio assumption is broken, right? Yeah, but still, it would be negligible if just 1 or 2 soldiers just, stand misaligned. It's still, the formation is still, looks, quite square, and that misalignment is, negligible. But if a lot of the soldiers are, standing misaligned, then the entire square formation is broken, and then arbitrage opportunities become available, right? So they are, capm APT are complementary. CAPM applies to individual assets, whereas APT applies to a portfolio. You know? So I think okay. Now, and APT serves the same function as CAPM, right? It can be a benchmark for fair rate of return for capital budgeting, security valuation, or evaluation of managed portfolios. And the past test of econometric test of expected return beta relationship revealed that and they examined rate of return on highly diversified portfolios, and actually it revealed that it was the test turned out to be closer to testing APT than CAPM. And therefore, econometric concerns too also favor APT. Okay, so that that takes us to the next level, next step, which is multi-factor APT, because if there is multi-factor CAPM, then there should be also multi-factor APT as well. And it's not difficult to understand, because we've already done multi-factor. In reality, there exist several sources of systematic risk. I mean, it's not just one systematic source of systematic risk. I mean, in CAPM, there was only usually, a single index, CAPM, right? The market, the S&P, the market portfolio is the source of the systematic. But on a more macroeconomic, in a more macroeconomic context, it's not the only source of systematic risk. There's macroeconomic variables that are really in play, such as business cycle, interest rates, energy prices, etc. Therefore, multi-factor model is in order. So well-diversified portfolio constructed. Well-diversified portfolios are constructed to have beta of 1 on one factor and beta of 0 on any other factors. Okay. Factor or factors. I'll leave it like that. Oh, yeah. I'll leave it like that. So let's take let's assume two-factor models, right? Two-factor models of APT. So, of course, these are risk premiums, right? Are always uppercase risk premium, right? Where RM1 and RM2 are excess returns on portfolios, right? Factor 1 is unanticipated changes in industrial production, so industrial. Factor 2, unanticipated changes in short-term interest rates. and the factor portfolio with beta of 1, the first factor will have, of course, if this is 1, it will be this. And then factor portfolio with beta of 1 on the second factor will have this excess return, right? And then other factor will be, by weight. You think about it. If there is, if you're using betting on the arbitrage on one factor, right? You will be shorting on all the other factors, right? All the other variables, rather. And then also, if you think about it, I mean, if you specify the model this way, right? And if the second factor is, short-term interest rate, first factor is industrial production, there is already an inverse relationship between the two. Isn't it right? When short-term interest rate goes down, that increases borrowing. Also, that induces more inflow of capital into the stock market. And industrial production will go up. Industrial production is, in a way, if you think about it, that's another term for GDP, isn't it right? It's, gross domestic product, right? No matter how you put it, right? Output of the economy, right? So, using that, we are going to look into to go over this. I mean, it's not a big, it's not a large, it's not a big example, but it will certainly take more than 10 minutes to cover this. So the rest of it will have to be discussed, in the next video, in the next session. But just to go over it, briefly, right? Suppose two-factor portfolios, 1 and 2. I mean, let's go over the setup of this example. Expected return on the first factor, 10%. Second factor, 12%, and risk-free return 4%. I mean, if the expected return on the second factor is 12%, it doesn't look like a short-term interest rate. Obviously, the short-term interest rate in the intro of multi-factor APT, that was just a random example, and whatever this second factor is, obviously, it doesn't. It's not, short-term interest rate, right? Something that has, a return, right? This, return this, big. And then they find, risk premium, right? And so we are ready to set up the model, right? So we're gonna continue with this example, with this in the next video. So let's see. We'll have to stop recording, and I'll see you guys in the next session. Thank you for watching.